we do it together? We'll answer questions
Okay,
later, 'cause they're gonna-
sure. You're the complaint department.
Okay, good. Well, they'll ask a lot of questions that'll simmer. I'm here because it was George's idea that I be here. He thinks that it's more interesting for people to hear what traders look at, what traders think about during the trading hours, during the trading day, when they're going to bed and when they wake up in the morning. And before I continue, two things. First, I'll continue the praises of Kitco. They've got a fantastic phone app, an iPhone app that I use not just to check prices on a regular basis, but it has news and charts, and it's a really good tool. So if you don't have that, take a look. It's a great little tool. And the other thing I wanted to do before I moved on to my prepared notes is, since I am lucky enough to be the one who's speaking as everyone's still falling asleep, I wanted to know, since George asked me to speak about these ideas, what is it, before I speak, that anybody might be interested in when it comes to what is it that traders look at? I recognize quite a few faces here who've been in the market for many years, and so you don't have any questions, but some faces here I don't know. Who trades in here on a regular basis? How's that? I'll start with the basics. Two? We have two traders in this room? Three? I'll start with the basics. I'll keep it simple so that we have enough time to drink after we're finished, and maybe even have snacks if we can fit in between the drinks. What do traders look at? This is a great question that was asked simply because you have to define a trader. The 2, 3, or 4 people who had the courage to raise their hand this high just a minute ago are not the same traders themselves. They might consider themselves all traders, but they don't actually look at the same thing. So I decided to break it down to the 2 basic types of traders. First, hedgers, which I would assume a good chunk of the IPMI represents, more hedgers than it does speculators. In fact, that's what it should be, that group. And the first hedging trader would obviously be the mining companies. Of course, mining companies, jewelers, all this stuff has been listed before I got to speak, which was great because you've got all that information that I don't need to get into. But the mining companies, so you have a mining company trader who doesn't trade too often, but he's always worried about his position because they need to answer to very angry shareholders on a regular basis. At least they're very angry these days, as their share prices don't go up with the price of their underlying metal. So they have to make sure that they hedge properly, unlike they did, what year was that when everybody was still hedging gold and gold started to explode? 02, maybe? No, later. I said, well, let's skip that. I'm not off the top of my head there. But there was quite a bit of anger at that point from shareholders when they were screaming for their traders to hedge more because the price of gold was flat for 15, 20, how many years it was. So mining companies very often have to answer to their bankers. Their bankers finance a lot of their production, finance a lot of their activities, and the bankers obviously will also handle their hedging. So the bankers make recommendations whether they hedge with options, whether they hedge with futures, or these days they might even go into the ETF market and do some activity if the bank deems it necessary for them to use that avenue. So mining company traders basically listen to their bankers. They do watch the market. They do look at price and see activity, and they can see what is coming out of their mines as it's being dug out. And so they have a better idea of what the future looks like than most of us in this room. Then another supply side trader might be, say, a recycler. We look at people in the recycling market possibly the same way we do miners, but I believe, and correct me if I'm wrong, and I am very wrong very often, recyclers are more like jewelers. They may be taking in supply and they have a better idea of what the supply-demand picture looks like on the retail side or even on the commercial recycling side than most of us will, but they have to treat their trading aspect as a jeweler might. As a jeweler might, meaning that they have to take care of how to hedge what's coming in as what else is going out. So these, on the hedger side, most traders will focus on supply and demand more than anything. They take a look at price, but price is only a mechanism to function, or a function of what it is that they're doing with the mechanism of their hedge at the moment that they need to do it. They might be looking at price last month, and there's nothing they can do about it until it's time to hedge, until they deem that it's time for them to protect their shareholders or protect their investors, as it might be. So they're generally looking at at numbers, figures, the types of things that you saw CPM put up today, types of things that Jeff and, I'm sorry, I forget your name. It's from Johnson Matthey, also posted some fantastic figures that they keep an eye on. They keep an eye on very closely because they need to protect themselves in that way. And just to speed things along here, outside the hedger, we have the speculator. As Patricia had mentioned before, the speculator is there for a reason to make the markets more fluid, to make the markets better for the hedgers, because there's many times that the hedgers do not meet up at price. They don't meet each other up in the middle. One guy might need to hedge in March, the other guy's looking to hedge in June, and unless they have a broker who's willing to actually take risk in the middle, or a banker who take risk in the middle, they will not meet up. And so the speculator, not that the speculator was created, I'm sure the speculator has always been around. The third oldest profession, maybe. The speculator is there in various different ways. The speculator can go from the individual, who had been mentioned by George in many ways just now in his talk on how people prepare to trade for their personal opinion to see how things work, all the way to the multi-billion-dollar hedge fund. And of course, when you go into a spectrum that large, we have to break it down a little bit, because the individual these days is not what the individual was less than 10 years ago. The individual less than 10 years ago, besides having a bigger bat to work with the lower margins and lower prices, they had the ability to move markets with what would be considered substantial size back then. 50, 100 contracts could move. That would certainly move the platinum market, and they would do it 10, 20 lots at a time. The gold market, that would still move the gold market, maybe only 20 cents, but it would move. These days, you don't see that. Individual speculators, because of the numbers that George just mentioned, are in there for a small play. They're in there for a bigger picture. So they are really just looking at news, reading every website under the planet, probably believing everything that GATA has to say. They're doing everything and anything they can to pay attention to their position, thinking that they are always right, and hoping that they are always right, more importantly. Beyond the individual, we start to grow. We'll have, we'll go with CTAs. CTA meaning commodity trading advisor. Commodity trading advisors can be small companies managing $10 million, which is nothing in these markets these days, all the way to billions of dollars. Campbell & Company, as an example, might be managing, I think, $7 billion right now. There are some other names, John Henry & Company, that you're familiar with, that also trade quite a bit. Typically, a CTA is doing more of what the individual graduated into. By focusing on charts and focusing on market movement, they develop either computerized programs or written programs or just systems of trading that they could spell out. In that manner, they're able to go out and raise capital for people to invest in their trading methodologies, and their methodologies are spelled out. So if you want to know how somebody's trading, go invest money with them. You'll find out how they're trading, and then you can actually trade against your own money and probably make a little bit more. There's quite a few investment banks that do this, actually. But they set up many different charting platforms. They don't just look at high, low, close. They don't just look at candlesticks. They'll look at various different moving averages and stochastics and RSIs, depending on the CTA. You might have a more sophisticated outlook on what that is, but very often CTAs are married to whatever it is that they told their investors they would do. They cannot really deviate. It's a static platform, and it has worked for many traders for many years, made them lots of money. Enough money that John Henry went out and bought the Boston Red Sox, and now he owns Liverpool Football Club as well. So CTAs, staring at charts does work for you. You just need to make a system. The index trader is a fairly new idea over the last 20 years. An index trader is somewhere between a CTA and a hedge fund. It's more along the lines of an in-house hedge fund at a lot of these banks and brokerage firms. Index traders are traders who take on positions and try to mimic or beat the either the Goldman Sachs commodity index or whatever commodity index they decide to trade and raise money against. And so these funds will put on positions, and it could be options positions, it could be all sorts of positions, and all they need to do is make more money trading these products by trading everything under the planet as often as they can. They scalp. They're not like a CTA in regards to the way that they trade. They're in and out of the markets all the time, where CTAs might hold a position. One CTA I do business for got long gold and platinum back in, I'll say 97. I think they're still holding the same position. They just continue rolling it, and they have no interest in getting out because you'd be shocked at what number they're looking at. And that CTA, for example, they came up with their figures off their charts, but they're mathematicians, so they ran their numbers off of some sort of programs that they had written. And back in 97, they started telling me how gold would see $7,000 an ounce and platinum was going to go to $20,000. And I said, that's laughable. And he says, yes, it is, but I'm long and you're not. So now who's laughing at who, right? So index traders, they trade in and out. They use a lot of information in the marketplace, not just the information that you were given today by our other speakers, not just the information provided by exchanges or by other studies that might be published or even news, but of course by their brokers and bankers and word on the street. They like to hear what's happening. Back in the day when open outcry was the rage, back where we all cry about, we miss those days. Back then, there was a lot more information flow. People had a better idea of who was doing what. So now to get that type of information, banks and use brokers more often to get some information flow, to see who's doing what kind of interest. Because a broker like myself, as you can imagine, will speak to various different traders and discover what it is that they're worried about, whether they trade or not. You find out what people are thinking about. So when the Swiss National Bank decided to peg their currency to the euro for some unknown reason, maybe they were jealous of Gordon Brown's decision from many years ago, when they made that decision and the price of the precious metals collapsed in a heartbeat, every trader I knew had no idea of what happened. Over time, people figured out what happened. It was simply that the market had been long, expecting some shoe to drop, and when a shoe dropped, everybody ran for the exit. And it just so happened to happen at a very illiquid time. If you remember those extended market hours that Patricia had posted, those low numbers that she posted, the pre-London hours, the big spikes on the right side of her chart were London hours, and those were much smaller than the New York hours. Those pre-spike numbers, that's when that announcement came out, and there was very little going on the screen. Whether it was everybody running for an exit or a hedge fund deciding to take advantage of some sort of news like this and test the market for downside, it could have been that. Or even better, referring to the option trading that George spoke about earlier. Currently on the COMEX gold options, for example, there's somewhere around 12,000, $1,800 calls and 12,000, 18.5 calls in the gold. And for the October, which expire at the end of this month on the 27th, anybody who understands options knows that whoever's long these pieces and the market's trading and having difficulty getting back over 1,900, they will sell to take their profit, and then they can just play that position back and forth. And so they're trading their gamma, they're making plenty of money, and that may be what has happened. So in comes the hedge fund. Now here comes the interesting thing, right? The evil hedge fund. Hedge fund started in the commodities world very much the same way CTAs started. In fact, many of them were CTAs and then changed over to hedge funds so that they could be more of a macro nature. They could make decisions based on however they felt that day or whatever they were hearing that day, whatever chart turned them on, whatever some broker, banker, some guy on the boat told them, I like this idea, and they liked the idea also. It just struck their fancy. They wanted to do that, so they turned their CTA into a hedge fund. So hedge funds are more open and more dynamic in nature than most other traders. And they are in and out. And as many of you know, being PGM people for the most part, Hedge funds can also gain a very bad reputation. Last year, it was this past year, a specific hedge fund was fined quite a few $1 million for trying to control the price of, correct me, platinum or palladium? Both. It was both. He was entering the close on the NYMEX every day and goosing the market as much as he could. At least this is what the Wall Street Journal reported it in a very interesting way. Nobody complained except a couple locals on the floor who were losing money. And you wonder why. So what did he do wrong? Because if somebody out there wanted to sell platinum and palladium on the highs every day, all they had to do was wait for the close if there was a pattern there. Everybody recognizes patterns and they trade. It didn't happen that way. But this is something that hedge funds do. They have done. They will probably continue to do, despite the fact that it cost them a few $1 million, because I believe they probably made more than they had lost on that trade. Hedge funds will try to muscle a market around. So when I mentioned before that it may have been a hedge fund that sold the metals down when the Swiss National Bank news came out, it could have been. Nobody knows for sure. In fact, it was last Tuesday. It was 2 days after the Swiss Bank announcement, or the next day it was. Just between London and New York openings, things get a little quiet as people in London decide to have lunch, and people in New York are just coming in for breakfast. So phone conversations begin. What's happened overnight? Who's doing what? Suddenly, somebody sold 4,000 contracts of gold in 6,000 contracts in 1 minute. And there was nothing there. And of course, the market dropped $60, whatever the number was. And why did somebody do that? Why would somebody with that big of a bat wait until there was nobody looking? Well, it was obvious. They wanted to see the reaction. That, of course, could have also been the option holder, who, going back to the ETF guys, Paulson and Company is a big name that everybody knows because they have the largest ETF position on the New York Stock Exchange, the GLD contract, the GLD issue. They hold the largest, publicly known, off the 13F filings, and it is said that they hold quite a bit of COMEX options against this stuff. They are holding a bigger bet than most people know. They don't need to share with the world what their futures and options positions are. So when they want to add to their position, especially after, as had been reported this past month, they're down, somebody help me here now, 30% for the year, something around that, Paulson and Company. But in another fund, the smaller fund, the fund that holds gold is up 27% on the year, and it's a lot more money. So he needs to make up that money some way. So maybe this is why they're playing with that position. Outside of charts, outside of listening to people like me make up stories on why people should trade because they need brokerage, because that actually happens. Hey, I think this is happening. I heard this was happening, and nothing's happening. People just trade off of a whim sometimes, and it happens. You know, because nobody will ever put on a trade unless it's something that they were looking to do anyway. Right? Think about your own books. Any position you've ever wanted to do, you don't actually make that trade unless you were just waiting for something to give you the trigger, and then you get that trigger. If it didn't happen today, it'll happen tomorrow. Some people's trading windows are the next 5 minutes. Other people are within an hour. Most of the people in this room, anybody tell me if it's within the day, or do you trade on maybe once or twice a day? Anybody? Bueller? No? All right. All right, so in summary, there is no summary. Trading is as varied as it is as people are varied. How people view the market and the perspective that people have is just as varied. So people try all different ways. People make money in all different ways. People lose money in the same way. Somebody might try and copy what John Henry's success was, and they're going to lose money. It has happened. Right, with Richard Dennis, everybody knows his story, right? Where he took on, I think, 30 traders, and he and his partner from C&D Commodities took people from out of nowhere, untrained, trained them to become systematic commodities traders. They ended up taking on the name Turtles. Quite a few of them are still in business, managing billions of dollars. But of that group, I think half of them are still successful. A piece of those that are not trading anymore, just they went off to have children, believe it or not. The women just like, all right, I'm done, and they'll be back. I'm sure they will. And then there were a few failures in there. But those failures, who knows why they failed, but there was success was taught. And that was Richard Dennis's experiment. So anybody, I feel like, has anyone seen this movie, Ratatouille? It's a kid's movie, a cartoon, all right, where the chef, his thing is anybody can cook, right? Anybody can cook, as the chef says, and people are insulted at this idea. Well, anybody can trade. Doesn't mean that anybody can be a good trader. But a good trader can come from anywhere, which was the whole point of that story. So were you expecting to hear anything else? Is anybody in here looking to see what crystal ball might be out there that I've seen or heard of or have spoken to and wonder what it is? Would anybody like to hear what I look at? Because I look at the same thing for over 20 years now. I use a candlestick. I use it 5 different time frames. I'll look at a monthly, a weekly, a daily, a 4-hour chart, and a 15-minute chart. And when the market's absolutely dead, I'll pull up a 1-minute chart just to excite myself because nothing's happening. Okay? But usually the 15s will give me an idea, an indication of what's going to happen just before I might want to do something, or I might want to check if it backs up my 4-hour in one day, depending on the clients that I speak to. I use that candlestick in those time frames, and with those I have the basic stochastics and RSI, just as quick indications of market mood. And then I'll use a 7, 14, 40, 100, and 200 period moving averages. I use them all. I use them. They've been working for me pretty well for many, many years, so I have not moved away from that. I found out that these numbers are very similar to a successful hedge fund that I do business with. He doesn't use the 7, 14, 40, 100, 200. He's using the 5, the 17, the 32, everyone's time frame. So our numbers might be off. When I pull up a platinum chart and I'll tell him that's the number, he'll say to me, how'd you get that number? And I tell him, he says, well, yeah, I got the same number, but my number's it just happens. So every once in a while, people have their stop number at the same level, and that's what causes excitement when people are all running for the exit at the same time or jumping in to the pool because the water's warm. So is anybody in here ready to jump in the pool because the water's warm?
Where do you see platinum at the end of the week, the end of the year?
Good question. You know why I like this question? Because these days platinum has been very quiet. It got quiet before gold got quiet, which to me told me gold was going to get quiet because trading started to draw back. The big speculators, the big hedge funds started to pull back on their activity. And so it took a little while for gold to slow down because gold being a hell of a lot more liquid took a little while before the guys started to lick in their wounds. I see both products going much higher. I see platinum at a premium to gold again. This backwardation situation that somebody asked about before, we've seen it a couple times in the past. The last time it happened, 97, I think, is the way I remember it. It went back, I don't remember how far it was back, maybe $100? Did it get to $100 backwards? But it took less than 2 months. And next thing you know, it bounced because everybody saw that this water is warm, this is silly, this doesn't make any sense. There's a hell of a lot less platinum in the world, and there's a hell of a lot more use of platinum in the world than there is for gold. So how can it last? So to that point, to tell you the word I've been hearing in the marketplace, a couple of dealers that I do business for have been long physical platinum for a very, very long time. They just sit on it, they roll it, they service their clients with this stuff. Over the last 2 weeks, they have no more platinum. They've been wiped out. Investors or manufacturers have been buying the platinum from them. They've been taking it off their hands, so a couple of these guys who are active in platinum just rolling have nothing. Now, if they wanted platinum, they have to enter the market. So if platinum does start to go up, these dealers are going to have to come back and reload, or they won't be in the platinum business, which they've been making so much money on for a long time. So you want a level. You want me to actually stick my neck out and tell you what price I'm looking for. This year or this month? When do you want it?
End of the week, end of the year.
End of the week? End of the year. This is a tough week. This is a tough week. I see prices dropping. This week I'm looking lower. All right, I'm looking for both gold and platinum to get somewhere under 1750. They're probably both dropping together. I don't see the backwardation going too far because almost everybody's talking about it. So it won't be like it was in '97 where nobody cared about gold or platinum, But now I see them both dropping. I don't see it going too far. There is a potential for it to reach out to 1680. This is the numbers I'm looking at. But that's not what I'm looking for. 1750 is my number. Anything beyond that would be stretching the rubber band, waiting for it to snap back. For the end of the year, now that we've already reached 1900, I could see us starting to climb back up and test the high 1800s again. Next year, if things continue the way I've seen them, I could see next year platinum getting up to 2200 and gold getting to 2100. Those are the numbers I'm looking at. Beyond that, I don't know. I'm not the mathematician from my CTA, but if you talk to him, he's looking much, much higher. Anybody else? You know, I don't think the drinks and food are ready, so I have to kill some time. So you're going to have to ask some silly questions. Anybody? I'm ready. They're ready? They're ready! Does anybody want a drink? Oh, look, finally got an answer. Thank you very much.